Every month, about 170 million Americans deposit their paychecks into bank accounts and assume that money just sits in a vault somewhere waiting for them behind a steel door and an armed guard. But the vault is mostly empty. The average bank keeps roughly 3 to 10 cents of every dollar you deposit actually on hand as cash. The rest of your money left the building before you even drove home from the branch. It was lent to a stranger buying a house, or handed to a corporation expanding overseas, or pumped into financial instruments so complex that even the people selling them can barely explain how they work. So where exactly does your money go, and who is getting rich off of it, and why does your bank's glossy brochure never mention any of this? When you were a kid, someone probably explained banking to you with a piggy bank. You put your money in and the money stays there, and when you need it, you break the pig open and take it back. Banks have been telling you essentially the same story your entire life, but with better furniture. They show you a marble lobby and a polished steel vault and a smiling teller behind bulletproof glass, and they tell you that your money is safe with us. And, technically, that is true. Your deposits are insured up to $250,000 by the Federal Deposit Insurance Corporation, which means even if your bank collapses tomorrow, the federal government steps in and makes you whole. That program has existed since 1933, and no depositor has ever lost a single penny of insured funds in its entire history. But safe and sitting there waiting for you are two completely different promises, and banks only ever made one of them. The moment you deposit $1,000 into your checking account, the bank is legally allowed to lend out the vast majority of it to someone else. This system has a name, and it is called fractional reserve banking, and it has been the engine of modern finance for over 300 years. Here is how it actually plays out. You walk into a branch on Monday morning and deposit $1,000. By Monday afternoon, the bank has set aside maybe $30 to $100 in its reserve and loaned the other $900 to a small business owner across town who needs to buy inventory. That business owner deposits the $900 into their own bank, and that bank keeps $90 and lends out $810 to somebody else. And the cycle keeps going. By the time the math finishes running, your original $1,000 has been multiplied across the entire banking system into roughly $10,000 of total deposits floating through the economy. Economists call this the money multiplier effect, and it means the cash you see in your banking app is not sitting in a drawer with your name on it. It is circulating through the financial system at a speed that would genuinely make your head spin. But that raises a pretty obvious question. If the bank already lent out 90% of your money, then what happens when you walk up to the ATM and ask for it back? Banks survive on a very simple gamble. They bet that all of their customers will never show up asking for their money on the same day. And for the most part, that bet pays off beautifully because on any given Tuesday, some people are depositing while others are withdrawing, and the flows roughly cancel each other out. The bank just needs enough cash on hand to cover the net difference between what comes in and what goes out. Think of it like a hotel that sells more reservations than it actually has rooms, because statistically a certain percentage of guests never show up. As long as that math holds, everyone sleeps in a bed and nobody notices. But every once in a while, everyone does show up. That is called a bank run, and it is the one scenario that keeps bank executives staring at the ceiling at 3 in the morning. When customers panic and line up around the block, all demanding their deposits at once, the entire math collapses instantly because the money simply is not there. It was lent to a family buying a 3-bedroom in suburban Ohio, or a tech company building a data center in Texas, or a hedge fund making a leveraged bet on European interest rates. In 2023, the world watched this exact nightmare play out in real time when Silicon Valley Bank collapsed in just 48 hours. It started with a single announcement that the bank had sold a portfolio of bonds at a $1.8 billion loss. Depositors panicked, and within 24 hours, customers attempted to withdraw $42 billion in a single day. That is a quarter of the bank's total deposits gone in the time it takes the earth to spin once. Customers who thought their money was sitting safely in accounts discovered that the bank had invested heavily in long-term government bonds that lost massive value when interest rates climbed. The money was technically there on paper, but the bank could not convert those bonds into cash fast enough to meet the stampede of withdrawals. By the second morning, federal regulators had seized the bank and it was over. But bank runs are the extreme case, and they make headlines precisely because they are rare. On a normal, boring Tuesday, your bank is doing something far more routine with your money and making an absolute fortune doing it. The way banks generate profit is almost embarrassingly simple once you see it. They pay you almost nothing for the privilege of holding your deposits, and then they charge someone else significantly more to borrow that exact same money. Right now, the average savings account in America pays about 0.45% annual interest on your balance. Meanwhile, the average 30-year mortgage rate sits around 7%. That gap between what the bank pays you and what the bank charges borrowers is called the net interest margin, and it is the single biggest revenue source for nearly every bank on the planet. Let's put real numbers on that so you can feel it. Say you have $10,000 sitting in a traditional savings account at one of the big four banks. Your bank pays you roughly $45 per year for the use of that money, which works out to about 12 cents a day. Then they turn around and lend your $10,000 to a homebuyer at 7% interest and collect $700 per year in payments. The bank just pocketed a $655 profit off your money while you earned enough to buy a mediocre lunch. And the wildest part is that most people never do this math because the bank never shows it to you on a single statement. Now, multiply that by millions of customers. JP Morgan Chase alone holds over $2.4 trillion in total deposits. Even a modest spread across that mountain of money generates tens of billions in annual revenue, and that is just from lending. Because banks figured out a long time ago that fees can be even more profitable than interest. In 2023, American banks collected over $7.7 billion in overdraft fees alone. That is money charged to customers who accidentally spent slightly more than they had in their accounts. Picture a woman buying a $4 coffee on a Tuesday morning, not realizing her checking account balance has dipped to $3.70. The bank covers the 30-cent difference and then charges her a $35 overdraft fee for the favor. She just paid $35 to borrow 30 cents. If you calculated that as an annual interest rate, it would come out to something in the neighborhood of 3,000%, which makes even the shadiest payday lender look generous by comparison. Overdrafts are just the appetizer. Banks charge monthly maintenance fees if your balance drops below an arbitrary minimum. They charge fees when you use another bank's ATM. They charge wire transfer fees and paper statement fees, and early account closure fees if you try to leave too soon. Some banks even charge inactivity fees if you go too long without making a transaction, which means they charge you for not using the account, and they charge you for using it too much. A study from the Consumer Financial Protection Bureau found that the average American household hands over somewhere between $300 and $400 per year in banking fees. That money does not fund better security for your account or improve your experience as a customer. It goes directly to the bank's bottom line. But everything we have talked about so far is what banks do with your money inside the traditional lending system. The largest banks also play a much bigger and much riskier game on the side. After the Great Depression devastated the American economy, Congress passed the Glass-Steagall Act in 1933, which built a hard wall between commercial banking and investment banking. The idea was simple, and it was that your checking account money should never go anywhere near Wall Street's trading floors. Savings deposits and speculative bets were supposed to live in completely separate universes. That wall stood for 66 years. Then, in 1999, Congress passed the Gramm-Leach-Bliley Act and tore it down. Today, a bank like J.P. Morgan or Goldman Sachs can take the steady, reliable income generated by millions of ordinary checking accounts and use that financial foundation to support trading desks that make billion-dollar bets on commodities and currencies and derivatives and complex financial instruments that didn't even exist 20 years ago. When those bets pay off, the profits flow to the bank's shareholders and executives in the form of dividends and bonuses. When those bets fail catastrophically, as they did in 2008, the consequences land on everyone else. Washington Mutual collapsed with $307 billion in assets, making it the largest bank failure in American history. Lehman Brothers vanished overnight, taking 25,000 jobs with it. Bear Stearns was sold for $2 a share after being worth $170 just a year earlier. The taxpayers ultimately provided over $700 billion in emergency bailout funds through the Troubled Asset Relief Program because the surviving banks were deemed too big to fail, and letting them collapse would have dragged the entire global economy into a depression. The executives who oversaw the catastrophe kept their bonuses. The homeowners whose mortgages had been packaged into toxic securities lost their houses. And after a few years of regulatory hand-wringing, the cycle quietly started over. This is not some fringe conspiracy theory. This is the documented and publicly available structure of modern banking. The real question is whether it actually works for the people whose money powers the entire machine. The honest answer is that several protections exist and they function reasonably well under normal conditions. FDIC insurance covers your deposits up to that $250,000 threshold, and that coverage is rock solid. Federal Reserve regulations force banks to maintain certain capital ratios, which means they cannot lend out literally every last dollar. Annual stress tests require the largest banks to prove they could survive a severe economic downturn without collapsing. And the Dodd-Frank Act passed in 2010 added meaningful layers of oversight that simply did not exist before the crisis. But none of those protections change the fundamental equation at the heart of all of this. Your money is not sitting in a vault. It is out in the world generating returns for the bank, and the bank is keeping the overwhelming majority of the profit. You get the security of FDIC insurance and the convenience of a debit card and a mobile app, and that is the deal whether you realized you agreed to it or not. Knowing all of this does not mean you should pull your money out and stuff cash inside your mattress. The system works, and the insurance is real, and keeping large amounts of physical cash is genuinely dangerous, but you can make much smarter decisions within the system once you understand how it operates. High-yield savings accounts offered by online banks currently pay between 4 and 5% annual interest, which is roughly 10 times what a traditional bank offers on the exact same deposit. The reason online banks can afford this is simple. They do not maintain thousands of physical branches with marble floors and mahogany desks and salaried tellers standing behind counters. Their overhead is a fraction of what Chase or Bank of America spends, and they pass those savings along to depositors. Credit unions are another option that most people overlook entirely. They operate as member-owned nonprofit cooperatives, which means any profit the institution generates gets returned to members in the form of better savings rates and lower loan rates and fewer fees. The average credit union consistently beats the average bank on virtually every metric that matters to your wallet, and joining one is usually as simple as living in a certain area or working in a certain industry. For people with larger savings, there are also treasury bills and treasury bonds, which let you lend money directly to the United States government and skip the bank entirely. When you buy a 6-month treasury bill, you are essentially doing what the bank does with your deposits, except you keep the interest yourself instead of handing it to a middleman in a suit. And simply paying attention to fee structures can save you hundreds of dollars every single year without any effort at all. Choosing a bank or credit union with no overdraft fees and no monthly maintenance charges and no minimum balance requirements is one of the easiest financial upgrades that most Americans never bother to make because they assume all banks are basically the same. Every dollar sitting in your bank account right now is living a double life. It appears on your screen looking safe and reliable and entirely under your control while simultaneously being lent to strangers and invested in markets and multiplied across the banking system in ways that would have baffled your grandparents. That is not necessarily a terrible thing. Fractional reserve banking is what allows businesses to get loans and families to buy homes and the broader economy to function at all. Without it, the modern world simply would not work. But the next time you open your banking app and see your balance, just remember that the number on your screen is a promise and not a pile of cash. And the institution making that promise is earning billions every year from the gap between what they pay you and what they charge everyone else. If you want to see more videos of what costs the average American even more, leave a comment below and hit subscribe.